Good morning. Welcome to our first webinar. My name is Stephen Basile. I'm the Executive Vice President and fourth generation family member of Catania Oils. Thank you all for participating in this event, but mostly thank you for your business and continued trust in Catania Oils. Based on the amount of people who have registered, about 180, I think many of you are looking for answers, and although there are a lot of theories and opinions on how this unbelievably crazy market will unfold in the weeks and the months to come, we are certainly not able to predict anything with 100% certainty, but we can provide you with knowledge and information. So whether you are a food manufacturer trying to set your everyday retail price over the next 3 to 6 months, or if you're a retailer trying to determine what your sales forecast is going to be in Q3 because consumers can't possibly sustain continued price increases, will the consumers buy less? Will they downsize on the shelf? Lastly, if you're a food service distributor or a restaurant, seeing price increases on every item, plasticware, dealing with ketchup shortages, mayonnaise shortages, labor shortages, we feel your pain. Everything we trade is at the highest levels in history. Tight balance sheets, strained supply chains, price increases on resin, cardboard, pallets, freight. Can this continue? How high is too high? One of our core values is customer focused. And the premise behind that is we treat your business like it's our business. All the knowledge that we have access to, we want to share with you so you can make informed decisions. So with that being said, we have brought you once again, Dave Reeble, a risk management and commodity expert to help shed some light on the various different moving parts and what to look for. Dave has an extensive background in various commodities, risk management strategies, and has traded oil for refineries as well as managed billions of pounds of purchased oils when he was on the desk for Conagra. For those of you who've heard him speak before, welcome back. And for those who will be hearing him for the first time, you're in for a treat. We are recording this event for those who are unable to make it or come a little late or might have to leave a little early. And if you have any questions during the presentation, please drop me a text in the chat and I will ask Dave all the questions on your behalf. So Dave, as we normally start off our calls every week on Tuesday, top of the morning to you.
Well, top of the morning to you. Let me go ahead and share my screen here so you can all see what we're going to be talking about. Obviously, you got to keep clear of moving parts. There you go. You should be looking at our slides. Now, this is a slide deck that we put together. Thumbs up from the guys at Catania. You guys hear me okay? Sound good? This is a deck that we actually put together over 2 months ago, and we've been continuously updating it since because, as you understand, as crazy as these markets have been, we get asked the question, what in the world is going on? And really at the heart of the issue here is this whole food versus fuel debate, and I titled it An Old Argument Reignited. The reason is we've seen a similar version to this about 11 or 12 years ago when the renewable fuel standard in the US first happened. Back then it was traditional biodiesel manufacturers. Everybody who was anybody and plenty of nobodies were building biodiesel plants. And there was a list on the National Biodiesel Board's website that was about as long as my arm of all the different projects that were being considered and plants that were being built. And at that point, we sat back and we asked the same question: how in the world are we going to find enough feedstock to feed all this? Well, as I'm going to try to show you today, we've got something similar going on today with a new entrant into the biofuel segment, renewable diesel. And I'll talk about what that is and what makes it different here in just a little bit. But as we go through this, and as I've looked at this, I thought, you know what, an alternative title here, and maybe more an appropriate title here, is The Perfect Storm. And so today I'm going to try to answer the question for you: why is soybean oil and every other kind of oil along with it, why is it so expensive? I also wanted to start out this morning by saying, if you feel like you're missing something, if you feel like you don't understand these markets, if you're wondering how all this could happen, at the very least, I wanted to assure you that you are not alone. I've been doing this for over 38 years now, and I have never seen anything like this. I have never seen anything like this in my life, especially the basis side of all this. So, again, I think the primary goal today is to try to at least help you come away from today with a little bit more understanding of what's going on and why these markets are so crazy. So here's the kind of the laundry list, if you will, of the perfect storm here. First off, I'll talk a little bit about the basis side of things, because we're not only dealing with historically high CBOT levels, but we're also dealing with the mother of all record highs when it comes to basis levels. So the primary reason that we've got basis levels so high right now, there's several things going on. The first and foremost of those is, as I mentioned, we have a new entrant into the renewable fuel space. I'll talk a little bit when I get to the appropriate slide here of what the difference is between biodiesel or traditionally produced biodiesel. If you're a chemist, methyl ester is what it's called. And the new entrant, which is called renewable diesel. Now, again, I'll get into what the differences are, but the first thing you need to know is that renewable diesel is primarily produced by energy companies. They're basically repurposing petroleum refineries to produce renewable fuel, and they make it out of soybean oil amongst other vegetable oil feedstocks. And the basics of what's going on here is we have completely, really for the first time in as long as I've been in this business, we have completely overrun available refining capacity. In other words, at this particular point in time, we're not actually out of soybean oil. We are out of the capacity to convert crude soybean oil into refined food grade edible refined oil product. And so that is why basis levels have gotten so high. And I'll talk a bit more about the reasons, but the basics, the executive summary version is this. You got a bunch of these great big brand new renewable diesel plants that are starting up. You have the traditional biodiesel plants that have been running for years that we've become accustomed to. They are also still running, trying desperately not to give up market share to the new kid on the block. And at the same exact time all this is going on, we have got food service demand that is absolutely skyrocketing right now. We have quite a few customers in the food space. We are kind of our tagline here at Moving Parts is that we do commodity risk management, farm to table. We really do cover the whole spectrum of the food chain, and we have a lot of customers in the food service business. Everything from like the folks at Catania and what they do, manufacturers. We have restaurant chains that we deal with, and everybody throughout that whole supply chain is telling us the same thing. And that thing is that they are overrunning their forecast, that demand is better, in most cases far better than they had forecasted to be. I'll show you some charts here when I get to the appropriate slide, but I think what we're seeing here is I think it's pipeline build. I mean, restaurant traffic is still supposedly below pre-COVID levels. However, if you look at overall demand, it appears to be at least at pre-COVID levels, if not a little bit before. And I think what we're doing is what happened at the beginning of this with the shutdowns on the retail side. Retail, as we started eating more at home, as restaurants started closing, we had to build that pipeline up. And I think we're seeing something very similar to that now on the food service side. So we have all these things happening at the same time, and we have completely overrun our capacity to convert soybean oil into refined oil. Now, as I'll show you here in a little bit, we could be transitioning here in the next quarter or two from problem number one, which is today's problem, which is refining capacity, to a problem of not having enough of the raw material. That is still debatable, and I'll try to frame that part of the argument up for you as well. But so that's a little bit of the backdrop that I'm going to talk about today on the basis side. We've also got Chicago Board of Trade or Chicago Mercantile Exchange soybean oil futures, whatever you want to call it. And I thought for effect here, when I first did this presentation a couple months ago, We were at highest levels since 2012. And then so I crossed that out. That's no longer the case. Then we were at the highest level since 2008. And then I crossed that out and I put ever. We truly have seen here in the last month the highest soybean oil futures levels that we have ever seen, kind of. So here's a little bit of a trivia question. The Catania folks have heard this before because we've done it on our weekly calls. But the trivia question is, are these really the highest futures levels ever? Now, I'll tell you ahead of time, it's kind of a trick question. If you look at the nearby futures month, the closest month in, it is the highest levels we've ever seen. But it isn't the highest futures prices we've ever had. Believe it or not, back in 2008, March of 2008, when we set the all-time highs, we actually had 3 billion pounds of soybean oil sitting around. That's massive stocks of soybean oil. And we actually had carrying charges in the market, unlike today, where we have gigantic inverses. And so this is the highest nearby futures prices that we've ever seen. But back then with carrying charges, the third or fourth futures month out was actually a good bit higher. So I'll talk about why that is. I think it's a bit of a market anomaly here. But there's a couple other things that are going on here. Palm oil prices are also historically expensive. Now, you may or may not care about palm oil, but palm oil is the largest producer of the world veg oils. Soybean oil is the second largest producer of the world veg oils. And in third place, way down the volume list, is canola oil or rapeseed oil. And so palm oil and soybean oil prices generally track together. And when this rally first started about 4 or 5 months ago, believe it or not, it was actually led by palm oil. Palm oil supplies were tight back in the late fall and into the early parts of this calendar year. And so palm oil actually is part of the perfect storm here. Palm oil prices actually started this, but palm oil's kind of fixed its supply problems here just a little bit. And now soybean oil prices are actually dragging palm oil prices higher. Right now, palm oil prices in the world market are at record large discounts to soybean oil. So what are the risks that we've got in front of us that I'll talk about a little bit more as we get into the slide deck today? The first question that I think I brought up was refining capacity. Will we have enough crude soybean oil to actually run the refineries at capacity? One of the other elements that I'll show you today, that is one of the other elements of this perfect storm, if that's what we're calling it, is that not only are we overrunning refining capacity, but we're also just about out of soybeans this year. In fact, as we speak, the USDA is forecasting soybean supplies will barely be enough to get us to harvest, maybe not even having enough. Now, I think over the last couple months, it doesn't maybe look quite that bad, but it looked a couple months ago like we might not have enough soybeans to get to the finish line here, the finish line being harvest. And that means one of the ways to ration soybean demand is dramatically slow crush rates. Well, the problem with slowing soybean crush rates is that the fewer beans you crush, the less soybean oil you can produce. And that's why the question arose of, will we actually have enough actual raw material to get it to the finish line? Now, I think we will. There are still differences of opinion depending on who you want to talk to, but that part of the problem might be dissipating. The second thing here is, will this acute competition for refined oil subside? I'll talk a little bit about that today. I think that there are some promising signs on the horizon that at least we could be getting, maybe get a little bit of a break coming up here. Possibly in the third quarter, might be the fourth or the quarter of this year. More likely we'll get some relief if we're going to get it. Might come actually out into the first quarter of calendar 2022. So that's a little bit about the when it might happen also. And then I'll also today talk a little bit about how does the market fix this imbalance. If I've learned anything in my 38 years in the commodity business, is that markets are masterful about fixing imbalances. I'll talk a little bit about how this is likely to happen in the short term, and then I'll talk a bit more about how it's likely to happen in the long term. So I would also, I think Stephen mentioned as we got into this today, Stephen mentioned that if you have questions, go ahead and put them into the chat bar. It's kind of hard to have an open freewheeling discussion with 150 plus people, but I would like this to be a little bit more interactive if possible. So if you have questions as I go through this, by all means, send that chat into to the Catania group, and Stephen, by all means, stop me whenever you see something pop up. And I would love to do this more of as a question and answer and a bit more of an interactive session than me just yammering on for 45 minutes or an hour. I do like to hear myself talk, and I think the Catania folks will vouch for that, but it does even get a little bit old for me sometimes. So here's your soybean oil futures chart. This is a weekly futures chart that goes back to 2019. If I had one that went all the way back to 2008, you could see that we have barely crested those peaks that we put in March of 2008. Many of you, some of you anyway, may have been around long enough to remember that market. So we're at the highest levels there, but it is really the basis on top of this thing that has gotten completely crazy. I've seen futures markets that have been almost as insane as this market, almost, I say. I have never, ever, ever, ever in my life seen anything even vaguely resembling this particular market. This is a refined soybean oil delivered to an undisclosed Midwest location. That's a current data point that we've got pretty good access to. You could see this is giving you about 10 or 11 years worth of basis history here. And I don't want to get too far off into the detail ditch, but we have a soybean oil futures contract that has a very effective delivery mechanism. And that's why the basis that you see historically there is just reasonably stable. Used to be in the old days, I mean, if the basis moved up 50 or 75 points or it moved down 50 or 75 points, we talked about it, we anguished about it, we tried to figure out why it was. Today, this market, as you know, is moving in 2, 3, 4, 5 cent increments at a time. And so this is the mess that we've gotten ourselves into. We've got basis levels that are, in many cases, cresting that 40 cent over level. We've never seen anything like this. I mean, you could see back over here to 2014, briefly pinched refining capacity. I think that was a biodiesel tax credit expiry situation back then. We pinched refining capacity a bit for a matter of 2.5 months. But this is more of an ongoing situation. And as you can see from the levels that we've achieved here, we have overrun refining capacity by some pretty wide margins. So what's at the heart of this? I call it the perfect storm, and I'll talk about all the different components, but certainly one of the components here is biofuels policy. To a lesser degree globally, in this particular case, more acutely our domestic policy that I'll get to in a second. But first, on the global policy side here, starting with the US, there's a couple problems here. Our mandate has gone up a little bit every year. That's part of the problem. But the bigger part of the problem here right now is that, believe it or not, the EPA still has not told us what our mandates are for renewable fuels this year, 2020. The situation in the renewable fuel policy in the US right now would be similar to being 5 months into the calendar year and not knowing what the income tax rates are yet for your own personal tax purposes. That would be, I think, a very good analogy. So,
Dave, we got a question.
Yeah.
Are subsidies paid on renewables as well? Where are subsidies now? Do you have any input as far as what the policies may be going forward? So just talk a little bit about that if you don't mind.
Yeah, no, I will gladly do that. That's actually a fantastic question. Yes, the dollar a gallon tax credit that is given at the federal level is available to renewable diesel, just like it's available to the traditional biodiesel manufacturer. Same rules, same dollar a gallon. So that subsidy is in place. As I'm going to show you here in just a little bit, there's something else afoot though. And I'll talk about the California program, which is really kind of the catalyst for all these changes. I think I'll save some of that powder till I get to the appropriate, the California CARB slide or the California LCFS program slide. But the executive summary version is this: California offers, their program is different than the federal program in that the federal program mandates gallons. The California program mandates carbon reduction. And so that's the crux of why this renewable diesel thing has started. Again, I'll get into more of that when I've got the appropriate slide here as a backdrop. But the California carbon credits at what they've traded at over the course of the last 2 or 3 months is the equivalent of adding another $1 to $1.50 a gallon, even for soybean oil, to the mix, to the incentive mix. So really good question, but yes, the answer is at the federal level, it is certainly the same subsidies are available.
Okay, on the same topic, one more question for
you. Yeah.
With all this new demand for biodiesel, renewable diesel, do you feel that a likely outcome could be that we're actually starting to crush, for the oil versus the meal? Does the role of the byproduct kind of flip because of this onslaught of new demand?
No question. That's another good question, but there's no question about it. Probably a good addition to this slide deck would be an oil share chart. When I say oil share, it is the percentage of the value of not necessarily the bean, but the bean and the crush margin. When you look at what that product value is, it's the share that soybean oil carries. Traditionally, something around a third, 30 to 33% is about a good long-term average. Last year with the shutdowns, we briefly saw oil share, not even that briefly, for several months dip below 30%. Yesterday's close, it was over 46%, to give you some perspective. Historically, over my 38-year career, I've never actually run this through our histogram, but back of the cocktail napkin math, we typically spend probably less than 5% of our time over 45% oil share historically. So that gives you another good illustration of just how unprecedented what we're seeing now really is. But no, we're definitely crushing for the oil right now. And that's why there's such a big incentive for some of the higher oilseed crops like canola. Certainly there's a big incentive to produce palm oil right now. To give you some perspective on that, soybeans are only about 19% oil by volume. And so to have a seed that is 19% oil by volume, but yet having almost half of its value come from the oil is unusual. Canola, on the other hand, 43 to 44% of that seed by volume is oil. And so a gigantic incentive for Canadian farmers and US farmers to produce canola seed. That's why we're looking at some pretty good sized increases in production. We don't produce a lot of canola seed in the US, but the USDA tells us that we're going to see about 16% increase in canola seeded area in the US. StatsCan says we're only going to see about 3.6% more canola acres in Canada. Most in the trade believe that we could be double that by the time we get done with the planting season. So another good question. I appreciate the question here. To make matters worse in the US policy, the state of Washington has recently passed a program similar to California's program. Oregon is considering a program like that. States of New York are also, another big state is also considering a program like that, are a handful of other states. To make matters worse, right here in the US, the Canadian government has also passed a program like this. Now, it's probably not really going to get rolling. It does have some requirements here in 2022, but they are very minimal. But that program should be kicking in full by the time we get to 2024, 2025. So, Anthony, I'm seeing some waving there in the background. Is there a question or something come up, or you hear me okay? All right. Other countries have got mandates. Anybody who produces oil seed like Argentina, Brazil, obviously the Europeans have a California style program. They actually, California program was modeled much off of the European program. The big palm oil producing countries also have programs of their own. So we've had this food versus fuel thing going on for quite a while, but it seems to be reaching a bit of a tipping point. Here's the US program. in a bar chart, which is a lot easier to see. The blue parts of the bar, that's termed conventional biofuel, otherwise known as ethanol. That caps out in the federal program at 15 billion gallons. A little bit of a problem with the 15 billion gallon mandate that I'll talk about here in just a second. In the orange part of the bar there, you can see this increasing, this ever small increases we've had in advanced biofuel. By definition, an advanced biofuel reduces carbon emissions by at least 50%. It's also almost completely synonymous with biofuel, biodiesel or renewable diesel. The vast majority of the volume that makes up that advanced mandate at the federal level is stuff that is made out of vegetable oil that you're competing with. Cellulosic, remember back a decade or so ago when we were going to teach the OPEC a lesson because we were going to make all this fuel out of switchgrass. Well, truth be told, we've never actually figured out how to do that. We seem to be able to do that in a laboratory on a desktop. Converting that to commercial volumes has just never proven viable. So the vast majority of all this advanced biofuel that's being produced right now is being produced by the people that you're competing with for feedstock. So let's talk about that. I hate these next two slides because when I've got a group this big and I put a chart up that's got this many numbers on it, eyes start glazing over and rolling back in the back of your head here. But let me try to make a very quick point here. First off, look at the 2021 line. We don't know what the mandate is. I mentioned that a little bit earlier. And part of the problem that we've got, one of the components of this perfect storm, is that when you don't know, there is even more risk. Bad news that is known is often better than not knowing. And that's what the market's trying to deal with right now. With the current administration, and again, I don't want to get into the politics here, but this is the administration of the Green New Deal. Even though we don't have a mandate, nobody thinks that when we get it, it's going to be lower. Everybody in the marketplace believes that when we do see the mandates from the federal government, they are going to be higher. And the fear here is how much higher are they going to be? Okay, you can see the advanced column there with the circle at the bottom. Many believe that it was going to be 5.5 to maybe as much as 6 billion gallons. Now, if you're following along at home here and you're watching the Reuters wire a couple weeks ago, there was a leak, probably a purposeful leak from the EPA that said, well, because of COVID, we're thinking about just leaving these mandates at where they were last year. Now, my initial thought to that was, well, that's pretty bearish. The market's initial thought to that was, well, that's pretty bearish. That's when we saw a little bit of a break. We saw market was down, well, probably as much as 3.5, 4.5 cents over the course of a week or part of a week. But it really didn't go down much more than that, and then it started to go up. And here's why. Now, when you look at last year, I don't want to get too far off in the detail ditch here, but we talk about mandates in terms of gallons at the federal level. But the way the process works, the EPA is supposed to propose mandates in May, and then they finalize those mandates after a comment period in November. But when they hand these mandates down to the energy companies who are the obligated parties, they're actually handed down as a percentage. The proposed volumes that the EPA comes with are then divided by the Department of Energy's estimates on fuel consumption the next year. And so if the Department of Energy says that we're going to use 150 billion gallons of unleaded motor fuel, the EPA has proposed and then finalized 15 billion gallons of ethanol, then 15 billion divided by 150 billion is 10%. And the energy companies are said, look, you've got to show that you blended 10% ethanol into the fuel stream. The little bit of one of the problem with that, or one of the reconciling items with that, is, and I'll try to get past this part quickly because I know it's boring, but it is very important to this part of the discussion, is that when you have a year like last year where you used a lot less fuel, your de facto mandate goes down. And this 2021 A line that you see right here is what the actual mandates ended up being with the lower fuel consumption. So even though 5.09 billion gallons was mandated, that's all that we were really required to blend because we use so much less fuel, okay? That's the good news. We actually produced this much with these renewable diesel plants starting up, so we actually overproduced last year's mandate. Well, that's great news, right? Well, here's the problem. The exact opposite happened on ethanol. One of the problems that we have with ethanol is that the effective blend wall is really only about 10.2 or 10.3% because of engine requirements, consumer demand, things like that. And so when we're only supposed to use about 137 billion gallons of unleaded fuel next year or this year, how in the world do you blend 15 billion gallons in it? Well, you don't. But here's the problem that we've got in the veg oil sector. I can't make more advanced or ethanol and substitute it for my advanced biofuel mandate, but because advanced biofuel reduces carbon by more, I can produce more advanced biofuel to feed the ethanol mandate. And so what you see here is that we, in effect, overproduced here to fill this hole right here. And what's likely to happen, that's likely to happen again this year. And I think that's why the EPA said, hey, we're going to leave the mandates where they're at. The EPA knows that if they mandate 5 billion gallons, we're really probably going to have to produce closer to 6 billion gallons anyway, just to fill the hole above the blend wall in ethanol. Clear as mud, I understand, but that is an important component of what's going on here. And that's why, even though that Reuters article a couple weeks ago looked like it might be a little bit of relief, it isn't. Now, it's still way better than having a 6 billion gallon mandate and having to produce another billion gallons to fill the ethanol blend wall above that. But we're still going to have to make a lot of biodiesel one way or the other next year. So I mentioned that the California program was a bit of a problem and has kind of really been one of the catalysts for a change here. And all that you really need to know about the California program is this. As I mentioned earlier, unlike the federal program, it doesn't mandate gallons, it mandates carbon reduction. Different all the energy companies are required to reduce carbon by X amount, okay? So how do they do that? Well, there's a lot of ways to reduce carbon, but what has become the easiest way to reduce carbon is by burning more biofuels. And here is the crux of why this renewable diesel craze has taken off. I'm going to jump around here just a little bit, but I need to talk right now about what is the difference between traditionally produced biofuel, what I termed methyl ester, and renewable diesel. This sounds pretty technical. I promise you I won't get too far off into the molecular chemistry ditch, but here's what you need to know. Traditionally produced biodiesel, otherwise known as methyl ester, you can burn it in a diesel engine. Typically, engine manufacturers don't allow you to blend it much more than about 10% without voiding the warranty, but it will burn at 100% in a diesel engine and run pretty well. Renewable diesel is molecularly identical to diesel fuel. Now, that may not sound like a significant difference, but it means everything. And here's why. The industry terms it a drop-in fuel. By drop-in fuel, what do they mean? You can drop it into the tank, you can drop it into the pipeline to transport it. There is no special blending, there is no special tanks. If you traditionally produced biodiesel, you have to have a separate tank to keep it in. You have to have blending equipment to make sure you blend it at pre-specified levels. There are no blending requirements whatsoever with this product, renewable diesel, because it is molecularly identical to diesel fuel. The other reason that that's so important in California is because if you've got this huge carbon reduction requirement by the California government, and you can only blend 10% of your fuel stream as traditional biodiesel, there's an economic incentive to blend more than that in, but the engine warranty manufacturers will not let you blend more regular biodiesel. This stuff you can put in as much as you want. You can't even tell it's in there because it looks the same as the regular diesel fuel. So that is why, because you can blend more of it.
Does it
If
behave
you,
any differently, Dave? Like, so biodiesel in the Northeast in the wintertime becomes pretty difficult to manage. How does renewable diesel act?
it acts the same, and that's a great question. What Stephen's talking about here is when you make methyl ester, traditionally produced biodiesel, out of soybean oil or really any vegetable oil feedstock, the cold flow properties are not the same as petroleum diesel. In fact, it will actually gel. You've heard when temperatures get real cold, even diesel fuel will gel. Well, this stuff makes that gelling in the wintertime even worse. This is why we typically don't use a lot of traditionally produced biodiesel, certainly back here in the Midwest in the wintertime. This stuff operates, it looks the same and it operates the same as traditional diesel. So it has the identical gelling properties as traditional regular biodiesel or regular diesel fuel does. That's another advantage. Now, it's not that much of an advantage in warm states like California, but that's another advantage as we see these carbon reduction style, LCFS, I call them, style programs come more into vogue. That's why we will see, I think this become even more popular because you can use more of it in the winter as well. Good question, Stephen. Thank you. Any other questions popping up there?
One more, but actually the timing of that question will be for this slide right here because it has to do with refinery capacity. So basically, the question is there additional refinery capacity planned to counter the demand?
Another excellent question. You guys have got some great questions coming up. So this is, I tried to mock up a slide as best I could to really show the problem here. It's a little harder to see on an annual basis, but that is the refining capacity that we have today. With all this renewable diesel capacity, we have swamped it. If I was able to, the numbers aren't actually given to us on a monthly basis, but if I was able to do this bar chart on a monthly basis, you would see that we are much further above the line here in the short term anyway than we even are when you look at it on an annual basis, okay? Is there additional refining capacity? The answer is yes. And really, it's going to come to us in two forms. I'll discuss this a little bit later here, again, when I get to the appropriate slide, but renewable diesel plants have got to have a pretty clean product to run. They run it through a gigantic piece of equipment called a hydrocracker, also referred to as a hydrotreater. It is, many of these petroleum companies are retrofitting unneeded petroleum refineries. Remember, with fuel use dropping, they have more refining capacity that they need. So that industry has been rationalizing anyway. And this hydrotreater is the piece of equipment in a traditional petroleum refinery that they use to process the distillate stream. Again, I don't want to get too far off into the detail ditch, but you take a barrel of petroleum, you crack it into pretty much unleaded motor fuel and distillate. The distillate is what is processed into diesel fuel, jet fuel, bunker fuel, a bunch of the naphtha, a bunch of other different products. You can run vegetable oil in this piece of equipment and separate and bust up those carbon chains to make this diesel fuel product. You also make naphtha. You're also going to make some propane. But they need a clean product going in. So where do they get that clean product? Well, many of them are starting up, as we know, on refined soybean oil, the same stuff many of you guys are buying to make salad dressing and all the other products that you make. The ultimate goal, however, for a lot of these companies and a lot of these plants is to process other types of oils, oils that are considered more dirty. Distillers corn oil, that's inedible corn oil that comes off the back end of the ethanol production process. Used cooking oil, yellow grease, inedible tallow, inedible fat streams. A lot of things right now that are currently going into feeding channels, animal feed. Most of these big renewable diesel plants have also announced what they call pre-treat. They don't need to have refined oil refined exactly the way you need it refined to be edible, but right now that's what they're buying to feed their plants. When they get these pre-treat plants built, they will be able to take in not only crude soybean oil and crude vegetable oils, but also some of these other waste streams. And longer term, that is one of the ways that the market's going to fix this problem. The next logical question, I would say, or extension to that question, would be, when are these things coming online? Well, another good question. There was a renewable diesel plant that was supposed to start in July. Their pre-treat was not going to come online until sometime during the fourth quarter. It's called CVR, I believe. They announced here to the trade about 3 weeks ago that they were delaying their startup until their pre-treat plant was done. So they are now going to start this fall. Some of the other pre-treat plants are scheduled to kind of come online end of the first quarter, out into the second and third quarter of next calendar year. So there is some relief on the horizon from that standpoint. And when you look at the refining margin that these crusher refiners are enjoying, the ones that are supplying Catania, I can't imagine that some of those guys are not tweaking capacity to increase their capacity a bit too. There is a tremendous amount of economic incentive right now if you have a refinery. And so I think we'll probably see some of those announced. Cargill, as you know, announced a couple months ago that they were expanding crush and refining capacity at several of their facilities. I think Bunge has had a very similar announcement to that here of late. And I would bet a good bit of my own money that the ones that haven't announced are doing it anyway and tweaking out capacity. So
Dave,
good question. Yeah.
Yeah, as we continue to see the renewable diesel ramp up, and subsequently you see biodiesel kind of, I guess, pull back a little bit. Are any of those biodiesel plants capable to be converted to renewable?
Not practically, no. You can't practically convert one. It's a completely different process. Building one of these renewable diesel plants is horrifically expensive by comparison. You can put up a nice little biodiesel plant for not a lot of money, at least in big industry terms, 30, 40, 50 million bucks. Even these retrofits where they've already got the big expensive piece of equipment are still hundreds of millions of dollars. And I'm told to build one of these big renewable diesel plants from scratch is probably not $500 million, but it could be approaching it. So that's a great segue of with these things coming online. So there's 2 points I wanted to make right here. And by the way, can you guys see my arrow? Can you see my my cursor arrow here? This is soybean oil that's going into traditional biodiesel production, okay? And you can see last year and this year, these guys are desperately trying to hang on to market share. Renewable diesel, for the reasons I mentioned, does seem to be a better mousetrap. It's not only the better mousetrap, but it's the new kid on the block. But you can see traditional biodiesel is still using over 700 million pounds of soybean oil a month to make biodiesel. Now, remember, right, they slow down in the winter. Remember, we don't like to use this stuff when it's cold outside. They slow down in the winter, but they're starting to ramp up and hang on for dear life to market share. And the new kid is coming online. The month of March, these two numbers added together is the largest monthly offtake of soybean oil to make renewable fuel of any kind ever. Okay. How long will these guys be able to hang on? That is the $64 million question to answer. The answer to the question of how does the market fix this in the short term? Okay. Here's what we know. The traditional biodiesel already had a lot of his products sold and a lot of his, almost all of his feedstock bought for this second calendar quarter that we're currently in. We are told anecdotally in the marketplace that there isn't really much on the books for Q3 and beyond. There's also no margin. At these prices, margins are negative to produce traditional biodiesel, probably getting close to being negative for the renewable guy also. But this guy, I would expect, and you can see our projections here, we expect some pretty hefty declines on the traditional side. That's the good news. This is the bad news down here. These guys are going to get bigger. And these are the plants that are running right now. These are the plants that are coming online that will be producing, will be using soybean oil, at least initially. And you can see the cumulative annual consumption of soybean oil and how it goes up and goes up dramatically between now and the end of 2022. So this is one of the problems that we're dealing with here, and one of the answers to the question of how does the market fix this on the short term is what is the mix? We have a pretty good idea, at least based on announced capacity, of what the ramp up is likely to be on renewable diesel. How quickly will the traditional biodiesel guy be forced out or forced to lower numbers? A part of the answer to even that question is, what is the federal mandate going to be? Again, remember, we don't have the answer to that question, which is aggravating the problem. You know, an ancillary question that somebody might have there, I get asked it all the time when I do this presentation, why don't we have a mandate for this year? Excellent question. The answer is because 2020 was an election year.
Yeah.
The best way not to disappoint a constituency group, and by the way, when it comes to renewable fuels, you are going to disappoint somebody. You're either going to disappoint the energy industry or you're going to disappoint the farmers in the renewable fuels industry. So what did the administration last year do? Kick the can down the road, let the next guy figure it out. So that's another part of this perfect storm here.
Two more quick questions for you, Dave.
Yeah.
Do renewable plants have the capability to refine waste oil? And are large, well-known oil companies like an ExxonMobil already in or moving towards advanced bio?
Another good set of questions. The first part of that is, do they have the ability to refine some of these waste oils? That's the pre-treat component that I'm talking about. Okay, when you look at the renewable fuel space and look at look at that top red box on the right-hand side, you see the D green. That's Diamond Green. They are part owned by Valero, which is an energy company. The other half is owned by Darling. Some of you may be familiar with Darling Enterprises or Darling Industries. They are an animal fat renderer. They're in the waste fat business. Diamond Green is the master of pre-treat. They only at this point use waste oil streams. These energy companies, see Sinclair on here? There's REG. Here is Marathon Oil. Here is CVR. Here is Phillips 66. By the way, CVR and Global Clean right here have basically got either agreements with or have purchased old petroleum refineries. Okay, so they are getting into it. The problem is in other words, they got the renewable diesel plant running first, and then they're going to add pre-treat later. And so that's the difficulty right now. Once that pre-treat gets added, there will be much less pressure on the refining capacity side of things. Hopefully that answers that question. Here's the other part of the perfect storm. I talked about retail food service spiking, okay? Or not retail, but the food service, what I believe is filling the pipeline. So the orange line here is food service. Now this is Bureau of Labor Statistics data. It is in dollars, not pounds, and it is category wide. So, but I think it's a good illustration of what I think is going on. The orange line, food service, when we had the lockdowns, we shut everything down, and then we came back up and we found our steady state. The blue line is retail. That's grocery stores in this case. You can see the big spike up while they filled the pipeline, and then they dropped back off that spike, and they reached a steady state. I believe that that's what's going on right here. It is hard for me to believe that food service is going to get up to these pre-COVID levels and level out here. I think what is likely to happen is that this is pipeline fill, and that we're going to settle out here at something that is above where we were during the lockdowns, but below here. Restaurant traffic counts just still don't tell us that we're going to be back up to here. I think we're going to settle out down here. I also think you'll see the retail guys at some point start to slow a little bit. But I think, again, this perfect storm is traditional biodiesel not giving up share, renewable diesel plants starting up, food service volume is to some degree right now off the charts. So here's another way to look at soybean oil use. I work with an economist named Bill Lapp. You'll hear me refer to Bill. It's Bill Lapp of Advanced Economic Solutions. Many of you on this call may already know who he is. He's very prominent in the food business, probably the best known and best food economist in the industry. These are his projections. He believes, and he has, I will tell you this, we disagree a little bit on this. He has drank the very bullish Kool-Aid. He believes that we will use almost record levels of soybean oil to make traditional biodiesel next year, and we will also simultaneously have to stomach dramatic increases in the renewable fuel sector. I'm not sure there's not enough product to go around. You can see my category up here, U.S. soybean oil use by category. Renewable soars, traditional maintains. We're all going to have to go on a diet, I guess. I don't think that's going to happen. The highest and best use, first thing they teach you in your economics class, highest and best use of vegetable oil is food. That is where it's going to flow first. The question, I think, is at what price? And then these guys are going to have to consume what is left. And I think that alone is going to limit what goes on here just a little bit, not to mention that the economics run out very, very quickly. This is another way to look at it. The USDA on the May WASDE, the May monthly supply demand report, started incorporating renewable diesel consumption of soybean oil into their reporting. And this is what they told us they believe is likely to happen next year. The orange line is food. The blue line is used to make biofuel of any type. And on the right-hand side, it's the percentage of domestic consumption soybean oil, the domestic consumption of soybean oil. We're going to use almost half of it to make renewable fuel. These are a couple charts that I think are kind of at the heart of this whole food versus fuel argument. One of the other questions I get asked all the time is, at some point, won't the federal government wake up and realize that they're causing food inflation and they're going to be at some point causing shortages? Again, I don't want to get into the politics, but whenever the phrase wake up and federal government are used in the same sentence, I cringe a little bit because often it takes quite a while to have an awakening. The second thing that I would tell you is that when you look at the Department of Commerce's food price index, believe it or not, less than 0.5% of that index is what is made up of vegetable oil. So it's going to take a long time for vegetable oil by itself to cause that awakening. However, as you know, food, just about everything in the food sector is getting more expensive. And in fact, I just read an article before I walked in to do this call that the UN's food index that they track globally is up almost 40% from May of last year. So eventually, I think that this argument could morph into a food versus fuel argument, and actually the moral argument at the global and at the federal level about, geez, we like to reduce carbon, but we also have this, starving poor people thing that's not politically popular either. So,
where are all the big CPG companies lobbying, saying, "Hey, what are we doing? This is stupid"?
There is a movement afoot right now for that to happen. Bill is involved with some of it. Probably shouldn't talk too much. Association, the NRA, the National Restaurant Association, different food groups. There's the dressings and sauces. The ADS is getting in on the act. Here's the lobbying problem that we had. And Bill's been involved in Washington in a lot of this stuff since its inception a decade or better ago. But one of the things he's told us is that 5 years ago, it was different. 5 years ago, when you were lobbying your congressman on this, on the one side, the anti-side is you had the food guys because food costs going up. You had the animal feed guys because their feed costs were going up, primarily corn into ethanol, right? And then you had the energy companies who hate these renewable fuel mandates. Today, that has all changed. Today, on that side of the table, only food remains. The feed guys have kind of figured out that, this really hasn't, over the long term, corn prices were back under $3 here not that long ago, and I can pass it on. So they have kind of exited the argument. The energy guys have swapped sides of the table. The energy guys have finally decided that, I'm going to join them. That's the way I'm going to beat them. And so now they're the ones putting up all these renewable fuel plants. And so now it is left to lobby only the food side. There will be a comment period. When these proposed mandates come out, and they should come out anytime, they're required by law to be given us in May. They're always late. The dog always ate their homework. We never get them till June or early July. But we should get proposed mandates from the EPA any day now, sometime between now and the 4th of July. There is a mandated 90-day comment period that will open up shortly after that. And that's where the food industry needs to mobilize and needs to make this argument right now, this food inflation argument. So another good question. So we're going to eat less. According to the USDA, we're going to eat less. Instead of food use of fats and oils that has always been price inelastic in the US, going up with population, which is 1 to 1.5% a year, they're saying it's going to go down. In fact, they're saying it's going to drop 5% on soy. We're going to go up almost 8 in canola. We're going to go up a couple in palm, but we're going to eat less. I don't think so. I don't think that's likely to happen. So how bad is it? Well, what you have lined up here is you have some balance sheets. These are some supply demand balance sheets. The USDA is saying that we're going to have 1.8 billion pounds of soybean oil around at the end of this crop year going into new crop. That's a tolerable amount. Minimum pipeline stocks is probably somewhere around 1.4 billion pounds. So it gives us a little bit of safety stock, but a long way from fat and happy. However, the USDA believes that we're going to drop down very close to pipeline levels next year. And look at biodiesel. The USDA is saying that we're going to go from a record large 9.5 billion pounds of soybean oil used to make biofuel up to 12 billion next year. Bill believes it's going to be even worse yet. Bill believes it's going to be even higher than that. And because of that, exports will drop to a minimum level. That's about as little as we ever export. That is probably not a tenable number right there. That is barely above pipeline stocks. That tells us that a continued shortage. Now, there's a lot of moving parts on this table here. Shameless plug intended. Could we export even less than 1.4? Sure, it's possible. Could we produce a little bit more oil than that? Possible, but that's already banking on a record crush rate. If we're going to see a big change on this, I think it's going to be right here in the traditional biodiesel line. I think that the holy grail that tells us how tight this market will get, both on availability of crude soybean oil to refine and refining capacity, is going to be determined by the fate of the traditional way into the sunset. So we still doing okay time-wise here?
Doing great. Keep rolling.
I'm going to talk too much about this. I told you bean supplies are tight. The USDA is saying that we are going to have an untenably short situation at 2.6% of use. Bill thinks it's going to be looser. I think Bill is much closer to correct here, but 4% of use at the end of the crop year, as we're waiting on the combines to start, is still a very snug situation. The broader message here is that we are likely to stay snug on soybeans next year. Now, this could change a little bit. Where's this going to change? Many believe, as do I, that when we get the final planting numbers from the USDA, this is their planting intentions number from the end of March. I think we're going to find out that we probably planted a couple million acres more soybeans. That's going to add 100 million bushels of beans to the bottom line, assuming that Mother Nature's kind to us this growing season. 250 million bushels of soybeans still isn't fat and happy, but at least it lets us take a step back from the edge of that supply cliff. So that's another little bit of relief. I'm going to tell you in a minute here, if you care about soybean oil prices, why you should care about the price of corn, but I'll get to that in just a second. So what factors could change all this? I already talked about Economics 101, and that is that resources, they teach you in the first chapter of any economics class you take, that resources will flow to their highest and best use. That is food. Food demand in the US has always been price inelastic. We have enough money in this country that we complain about higher prices, but none of us change our eating habits. We've proven that every single solitary time we have a price run up in the price of veg oil. Okay. However, when you look at mandated volumes from the federal government because of a program, well, if the government says you're going to use it, that becomes relatively price inelastic as well. Okay. The good news is, so far, the companies that crush oil seeds have also figured out that, you know what, those food guys are going to be here through thick and thin. And so far, the crusher refiners have been pretty good about saying, not selling our oil to the renewable diesel guys, much back for you, but I need you to tell me if you're going to use it. And if you're going to use it, I need you to buy it because I've got a willing buyer standing off here in the wings. And so far the food companies have been pretty good about at least making sure that we're able to get it. One of the things that we are doing, and that I know that Catania is doing, is talking with the suppliers on a very regular basis, making sure that they understand what our forecast volumes are, and that in fact, yes, we are going to need it. Renewable diesel is a better mousetrap. As I mentioned before, one of the big telling items here, probably the biggest, is when will traditional biodiesel slow and by how much? Again, a lot of that's going to be dictated by what the government tells us the mandate is. So we could have a bit more clarity of that here shortly when the government gives us proposed mandates for not only this year, but likely next year as well. When will the renewable pre-treat capacity come online? Most of the projects look like they're scheduled to come online as we move out into the early months and the first half of really 2022. Does that mean we're going to have this refined tightness at least for the better part of the next 12 months? I think that's possible. I think we could get a little bit more relief from the traditional biodiesel sector than some people do. But again, it's going to be highly dependent on what the EPA tells us, which takes care of that next bullets. Again, I showed you the other part of the problem. We got two problems here. Today, we have enough oil. We don't have enough refining capacity. At some point in the future, we're going to cross that line where we're going to have maybe enough refining capacity when the pre-treat gets going and traditional starts to give up. But are we going to have enough soybean oil feedstock to feed this whole mess? That's the two problems that this market's trying to deal with. Another issue that's down the road a bit is that we have this renewable fuel standard, the RFS, that's the Federal Renewable Fuels Program. It actually ends at the end of 2022, not to complicate matters. Now, that doesn't mean that it's going to go away and we're not going to have any blending requirements. The way that the law is written is that basically turns over purview of this program to the EPA after that. We're hearing that it's very likely that Congress will probably not take it up this summer, but they will take it up next summer and likely change the program. Many people believe that they will change it to more of a California or European style program that mandates carbon reduction instead of mandating gallons. This is the whole cap and trade. These are the targets. You guys, these are the rules of the game. You guys figure out how you're going to reduce carbon. None of this, by the way, takes anything away from renewable diesel. That's why this looks like a better mousetrap, because it's entirely possible that the federal program a couple, 3 years from now looks a lot more like the California program and the European program than vice versa. So, any questions showing up there, Stephen?
Not right. I mean, I got some questions, but we'll keep rolling.
So a couple more points that I wanted to make here for you. Some of them related, some of them ancillary, but important at this part of the year. I know many of the people on this call use soybean oil, many use canola, many also use specialty products. Catania is one of the leading purveyors of specialty oils in the country. And you're probably wondering why I'm showing you a spring wheat area and drought map on the right-hand side here. The reason is that a lot of these specialty oils that are grown in the U.S., or at least the seeds that produce those specialty oils, also end up being grown in the same spot as we grow spring wheat. This green area right here, especially the top half or 2/3 of it, is where we grow virtually all of the canola that is produced in the U.S. A lot more grown up here into Canada. Okay, so they grow a lot of canola here. Almost all of the sunseed, really all of the sunseed that is grown in the U.S. is grown in this drought area. We're relying on Mother Nature to be much more friendly very, very quickly to get the problem solved. The other problem, arguably every bit as big, if not bigger this year, is that with the price of everything else being up, everything that a farmer grows, he's able to make a lot of money. It is a lot harder to convince that farmer to sign up to grow committed acres to specialty crops. In other words, if you are asking a farmer to grow non-GMO or high oleic canola and sign up for a specific acreage program to commit those acres, those are offered at a typical grower premium. The farmer gets a premium. And when the price of regular canola seed is $485 a ton and it is below his cost of production, his break-even cost of production, and he can get a bit of a grower premium to grow a specialty crop that gets him over that profitability line, he's much more inclined to take that than he is right now, when he can sell his new crop canola for almost $750 a ton. Tremendously profitable. And getting that little bit of a grower premium, he's not as interested in. Sunflowers are kind of a pain in the butt to grow. I've heard several farmers tell me that. Well, why grow something that's a pain in the butt to grow when the regular stuff, I can put corn on that ground, I can put soybeans, I can put canola, I can put a handful of other crops on that same acre of ground and make quite a bit of money. And so we are hearing that acres, the USDA tells us that sunseed acres in the US are likely to be down 27%. 27% acreage base reduction before you even start. Now, again, companies like Catania are very heavily invested in the supply chain. I know that there is the possibility and that you guys have actually imported product before. And the good news on sunseed is that the world crop is expected to be record large. So, but just wanted to kind of, Stephen thought I should probably talk about this. We went limit up on Monday because of this forecast. After all the rain that we've had in the Corn Belt the last 4 weeks, my point here is very simple. This is going to be a rocky road this growing season. This market is going to be, because of the very tight supply situation, is going to be extraordinarily reactive to weather changes. So prepare for some volatility is the message there. Here's the Canadian maps. We were very, very dry. We've been very, very dry here coming into the planting season. Good news, bad news in Canada. The dryness has allowed Canadian farmers for the first year in the last 4 to actually get their crops seeded in good time, actually a little bit early. The last several years, it's been too wet to plant, which has been bad. And the other bit of good news is that it actually has started raining in Canada. You can see the 30-day weather map here is much better. But just like the northern plains, the Canadian prairies have no subsoil moisture to fall back on. They have been very, very dry coming out of the winter. And because of that, we're going to continue to need to get timely rains on the Canadian prairies if we're going to produce a canola crop in the US. This is titled, Why You Should Care About the Corn Market. You're probably wondering, well, this is a vegetable oil thing. Why are we talking about corn? Well, the reason we're talking about corn is because corn is king. We produce more corn in the US than everything else combined by volume. Corn competes with acres with just about every other crop out there, okay? And therefore, corn is what we term a foundational commodities. I mean, if you asked me to pick 2 commodities to watch to give me a good indication of what the price of everything else is going to be, I would tell you I would pick corn and crude oil prices, petroleum prices. Those are foundational commodities, okay? The corn market, like everything else, is crazy right now because the Chinese are buying like there's no tomorrow. And a big component on what the corn market does, currently new crop corn prices are about $5.70 a bushel. That's very expensive historically. Whether they stay here, go to $6 or $6.50, or whether they go back down to $4, which is where they're historically at much more frequently, is going to be determined by 2 things largely. It's going to be determined by what Mother Nature gives us this growing season. So far, so good. Got a great looking crop that was planted early, but we got a long growing season in front of us. It's also going to be determined by what the Chinese do. So this is the corn that they have bought from us for the last 10 years. This is what they bought from us this year. Gigantic departure. If you believe they're going to do this again, as the USDA does, okay, well, maybe corn prices stay up here. But if we actually find out, as I and many believe we will, that we're going to plant at least 2, maybe 3 or 4 million additional acres of corn, that helps things out. And even if the Chinese demand falls back to somewhere in here, which would be the 2nd largest year in history, we got corn prices back to $4. Here's the reason that's important to you. Corn goes back to $4. Beans are not going to be 14 or 15. They're going to be 10 or 11. And if beans are 10 or 11, soybean oil futures are not likely to be 55 or 60 cents. They could be carrying, they could even have a larger share of the oil share and still be in the mid 40s. So I do not want to be on record as predicting oil prices back into the mid 40s, but that is a scenario that could make it happen. And that's why you should care and should watch the price of corn. Everything's going up. You've probably seen this before. Soybean oil and canola oil at the top of that, that is the part that's unusual. Typically, it's the specialty oils that are higher and more expensive. What does this tell us? Well, it tells us that some of the specialty oils are maybe a little bit too cheap right now, or it tells us that soy and canola are maybe a little bit too expensive. I certainly hope it's the latter, but we've got poultry fat. This is used cooking oil in here, white grease. Right now, this renewable diesel capacity that is starting up cannot use this product because they don't have their pre-treat capabilities. However, once they get that pre-treat plant built, and once they learn how to run it, which I think there's going to be a bit of a learning curve here, but longer term, to summarize this, longer term, the two ways that this capacity issue gets fixed, we start using more of this sort of product when they get pre-treat built. And also longer term, there are other oil seeds. I had one of the renewable diesel manufacturers told me a week ago that they've actually got in their budget that next year, 10% of their feedstock is going to come from camelina. Camelina, pennycrest, many of these other products are inedible, but they are actually contracting acres for farmers to grow acres. It is a cover crop that is grown off season primarily. That produces a seed that produces oil. They've also contracted with some crushing plants to crush and produce that oil so that they can use it as a feedstock. So longer term, the market is looking for other feedstocks to use. Many of these are going to have to get their pre-treat capabilities built to take care of. That's how we fix things in the longer term. In the shorter term, how do we fix this? I think in the shorter term, the only way this gets fixed, honestly, is by traditional biodiesel giving up on part of their capacity. So that is what I've got today, folks. Any more questions popping up there?
Yes, sir. Got a few here. One, just kind of, what are your thoughts on, the whole CRP program, kind of where that's at right now? Anything getting pulled out at these high prices? What do you know about that?
Well, CRP and more broadly, this 30 by 30. You guys have probably seen this Biden administration. 30% of acres in the U.S. back to their natural state by 2030. Okay. What that means is part of this is they've got some very aggressive expansion ideas for what we know today to be the CRP program. Now it's going to be called something different. It's going to be administered a bit differently, but there is going to be a big push. And this all goes to this broader picture of all this green stuff is wonderful. And we all believe that we need to save the planet, but it does not come without a cost. We are living that cost today in the vegetable oil market. But you need more acres to feed people and renewable fuels, and to continue to push the renewable fuels requirements and carbon reduction requirements higher at the same time you are pushing to take acreage out of production is another tipping point that we're going to have to deal with at some point in time. How does that fix itself? Well, it's a political question, and I'm not a politician, nor did I stand a Holiday Inn Express last night. So no idea how that's going to end up working out. But you get the idea here that there is a tipping point in here that we are already starting to see in some markets that we are going to have to deal with really as a people. That's what politics is what do we want to do as a people? And the problem is all these things sound wonderful, but the reality is that there are realities that come to bear here that we're going to have to figure out a way around. So that's as close as I'll get to politics for you. How's that?
That's great. All right, got a couple more, kind of combine these questions, but in general, China's has mandated more acres on corn and beans. What does that really do when you're looking at overall demand from China consuming 2/3 of the world's soybeans? And then you look at South America and how much land they have down there. Are they going to continue to add acres? Can they really offset, some of the export that the U.S. continues to send out on on an annual basis. And then you have the US then importing soybeans back to the US. You got Canada importing canola seed back to Canada. So this whole globalization trade, like how do you really see this kind of unfolding a little bit, specifically with China looking to add some acres in South America? How does that play into the mix?
Yeah, a lot going on in that question here, but again, if you set the politics aside and assume for a second that you're going to kind of continue down this renewable fuels road that we seem to be well into at this point, where the extra soybean acres are going to come from is going to be from Brazil. They have got this tremendous center of that country. They've got all this grazing land called Cerrado. Contrary to popular belief, we are not knocking down the Amazon rainforest to grow more soybeans. We are knocking down Cerrado, which is this big, it's like pasture land, a lot of small scrub trees on it. And that is where all these acres have come from over the last really 20 or 25 years, a big chunk of my career. That's where a lot of these additional acres have come from in the world. The trend that the Chinese imports for soybeans were on prior to the trade wars with Trump and then the African swine fever issue with their hog herd was that we need about 2 million more acres of soybeans every year. Those were coming from, some were coming from the US as we switched from corn to soybeans. Most of those, however, were coming from other parts of the world, primarily Brazil. I think we will go back to that, and I think that Brazil will continue to carry a larger and larger and larger part of the world export trade in soybeans. The bigger question to me goes right back to this corn slide with China. Okay, there are two schools of thought here on why we had the big spike this year. Clearly, China had a production problem with those 4 typhoons that rolled right into the heart of their corn growing area last year. Now, Chinese would tell you that their production numbers were only down a teeny tiny little bit from the prior year. I think that's propaganda, and that's the cause of this. However, one of the things that is happening in China is they are changing how they feed their livestock herds and their poultry flocks to become more biosecure. Most of their pork has been produced, basically a handful of hogs on a small farm in China. That's how it's been done. You can't have any biosecurity in that, and that's why ASF ran rampant through that country, but yet it doesn't seem to burn through like wildfire in advanced countries like us in Europe. Because we have these great big confinement operations, the biosecurity is tremendous. Doesn't mean that it can't get into our herds, but it's much easier to keep it out and to control it if it does get in. When you go from backyard farming to big mechanized pork production like we have here in the US, you feed a much more technical or professional ration that has much higher inclusion in corn. There is no doubt that China is moving in that direction. I just question if we go from here to now, all of a sudden, this becomes the new norm. I think we're going to settle back somewhere down in here and then maybe start trending higher. That's more near term than longer term. But I think in the longer term, Brazil produces more soybeans. We're going to end up probably having to produce more of the world's corn. More of the world's corn is also probably going to continue to come out of the Black Sea. The Ukraine and to a little bit lesser degree, Russia, have really over the last decade and a half gone from very little wheat production to the largest exporters of wheat on the planet. They're not quite challenging us from a size standpoint on corn exports yet, but they could be in a handful of years, especially if prices stay anywhere near where they're at right now. So that's how I think the global situation looks maybe 5 or 10 years down the road.
Good. Got a few more questions coming in here, Dave. So one is with all the plans of expansion, I'm assuming that this is plant expansion, refinery capacity. Is there a possibility of overproduction of oil in the future?
Boy, it would sure be nice to get to that spot again. History tells us that, yes, we will be there again. Markets fix things. One of the things that I have learned, or one of the philosophies that I have because of the things that I've learned over the last nearly 4 decades, many of those lessons, by the way, I will admit, come the hard way, as often happens in this business. But whenever there is a prediction, something like right now that we won't have this refining capacity or soybean oil issue fixed for another at least 18 to 24 months. Here's Dave's philosophy on that. Whenever you hear a time figure like that, divide by 2. And that's just something I've learned over the years. And the reason is when there is the economic incentive right now to produce more of something, there certainly is for the farmer at these prices. Refining margins are so insanely high right now that there is a tremendous economic incentive to debottleneck, if you will, your refinery, or to add another piece of equipment so that you can kick your production up 10 or 20%. And by the way, we don't need to double capacity. In this business, it's always been this way. The last 5% prices the whole crop is the old cliche. And what that means is you can be out of capacity. You can overrun capacity by 5 or 6% and have a train wreck like we've got right now when you get to inelastic price demand. But you've only got to tweak out capacity a little bit to fix this. And when there's this much economic incentive, history tells us that not only are we likely to have an overbuild, but it's almost certain. The question is, do we enjoy the fruits of that 2 years from now, or do we have to wait longer than that, is what I would say.
Great. All right. I believe this is one of your last charts, Dave. Question is, on the cash veg oil prices in nearby soybean oil futures chart, can you explain the difference between the futures line and it looks like the TBD soy oil line? Does the RBD line have any basis in it? I don't know if that was
that's that one.
Yeah, I believe, yes, this one here.
Yeah, these are cash prices. This is reported by the Jacobson. They are kind of an accumulator of data. They buy data sets from them. It's actually proprietary. I mean, Bill subscribes to them, but we're not necessarily publishing something that we shouldn't. But this is actually refined. Okay, so when you look at their RBD, they're basically a little over 98 cents a pound is what the prices that they've observed this week. Actually, it's a couple weeks old here, or a week old. That includes the basis, RBD soybean oil, and I'm not even sure, this is probably a Midwest type basis point, but that is the board plus the basis. So it will be the nearby board plus the current nearby basis, which is obviously hard to come by because you can't even hardly get a basis price for spot shipment right now.
That's right. Great. Okay. Another question here. Could you explain how and if speculation has played in the board futures
that are markets for a matter of months? On our weekly calls, I've showed you guys here a month or two ago, 1983 market was a big market. And I showed you that, yes, that volatility does often signal a top, but often that top can take 2 to 3 months to put in. Well, it could still be a signal of that, but I will tell you this, we have been dealing with this sort of insane volatility now for coming up on 3 months. So is that too something different that's about this market? Or is this just a little bit of a longer spread on this top? I don't know. I will also say from a timing standpoint, where we're at in the growing season, the market is going to have to be comfortable that we have a corn crop, and the market's going to have to be comfortable that we have a bean crop. You make your corn crop in July and you make your bean crop in August. And so we got some summer to get through here before I think we have much hope of seeing some of this volatility go away and possibly see a little bit of a relaxation of these prices. Be very unusual to see a market calm down and break in June.
All right. One last question here, Dave. Will the U.S. allow canola oil into the renewable segment? And if so, is there a timeline or a guess estimate that you think?
The answer to the first question is easy. Yes, that is very, very likely to happen. I put a percentage on it. I would guess probably larger than 85 or 90% chance that it will get approved to go into renewable diesel. It's already an approved feedstock, as you know, to go into traditional biodiesel. From what we are told from the people in the canola groups that we deal with who do have a horse in the race, they believe that the announcement could be any time now. What you're hearing out of DC at this point, I mean, it's Washington, DC, and nothing happens on a schedule, it doesn't seem like. Could we get an announcement next week? Yes, we could get an announcement next week. Could we still be waiting for one by Thanksgiving? That's possible, but I think that what's most likely at this point is that we will probably hear something in the affirmative in the next, I would say in the next handful of months is the most likely.
Okay,
So
sorry, I lied. There was one more question that just rolled in.
it's all right.
Some customers are just, concerned, or maybe you've heard other information from, other suppliers within the industry that where we could be at risk of not having oil in, Q4 or in 2022. So, I know we kind of talked about that a little bit, but, just, can you kind of just set the table a little bit as far as, is there going to be oil to go around for everybody come 2022?
It is concerning, and I share your concern. I believe that there will be, for the reasons I mentioned earlier. Most of these crusher refiners have been pretty good about, you know what, I'm not going to sell your oil to this renewable diesel guy who will pay me just about whatever I want for it without giving you a crack at it first. And so the advice that we've been giving our customers is this: before price, supply chain. And what I mean by that is protecting your supply chain right now is far more important than what you pay for it. In the short term, they may even continue to go higher in the medium term, but buying the highest number you've ever seen because you're afraid it's going to go higher still is not good discipline. But what you do need to do is you need to stay very, very close to your supplier. And I know this is what the Catania folks are doing. You need to stay very, very close to your supplier. And when your supplier tells you, look, you need to buy this, or I may not have it for you, that's when you need to make sure you buy it. So your purchasing decisions here at these insanely high prices needs to be primarily focused on supply chain and not trying to outmaneuver this market, because you will not be able to outmaneuver it. That is physically, it's just not possible. You might get lucky, but you're not going to outmaneuver it. You should protect your supply chain. Price is very much secondary right now.
Well, that seems like it was the last question, Dave. So a lot of great information and questions that we just spent with you for the past 90 minutes. I'm hoping that everybody here took something out of this. And we're certainly going to be interested to hear your feedback on this webinar format and how this worked for you. So if you don't mind completing a brief survey to follow up, that would be much appreciated. Thanks again to everyone for participating. Dave, thank you so much for your time and wisdom. It's always great pleasure to speak with you. And as we always end our weekly calls, be careful out there.
Be careful out there. It was a pleasure. Thank you guys very much. Good talking to you today.
Ciao.
Take care.